Hello guys, welcome back. We are going to attempt to analyze Affirm Holdings, a company that has been up about 30% today. I can take a little bit of a close look at what is currently happening with its stock price. Yeah, as you'll see, it's about 31% right now, higher than yesterday, and it's on a higher trajectory, generally speaking. It closed at about 1463, it looks like, 2 days ago, and right now it's at 23.32, so it's on a massive uptrend. So what's going on with this company, and what we can tell about this one? Is it a good opportunity to buy? Now, this one is a platform that actually allows for digital and mobile first commerce in the United States and Canada. It's interesting to notice that this kind of company operates on a buy now, pay later principle. So they are basically providing credit to consumers. And most of the credit I've read that it is like a 0% interest, but there is also interest based credit. And so it does handle credit, and so it does handle debt. And when we're talking about these kinds of companies, it's always a little bit problematic to actually analyze them. I have talked about it in the past, and in this video I'm going to attempt to analyze in a similar manner. But you need to realize that banks, financial institutes, or insurance companies are not the same thing as a tech company, for example. Because if you're a tech company, you're creating a product, you're creating a service, and you're selling it to consumers. But picture yourself being an insurance company. Then you also have claims to settle. And these claims create loss adjustments to your actual net income. And so you're getting hits from these events unexpectedly, potentially, in some situations. And also, a bank, for example, a financial institute that is handling debt, if it's based on interest, if its operations are mostly based on interest, then you have to know how much interest they are gaining on top of their debt that they have. So it can be much more complex to actually analyze a bank of that sort, or a company that has a lot of credit, and it does require a lot of digging deeper in financials, especially if you really want to understand what a company is doing. This one seems to be a little bit of an in-between thing here, and it doesn't seem to be handling that much interest, generally speaking, but still we want to be handling it as a company that is like a financial company here. And so for this reason, one of the key metrics that I want to examine is definitely the price to book value, or the price to tangible book, pretty much. Now, of course, profitability matters, and so let's take a look at what Affirm is doing here. It's up 30%, as you'll see. Higher rates have not been a real impact on cost, and that can become an impact on cost as the market is having higher rates, of course. As you will see, they have reported strong Q3 results, lifted guidance, revenue guidance for the full year. Now, lost 19 cents per share in the third quarter versus the year ago figure of 1.23, which is significantly better, of course, than what they did 1 year before. But revenue popped up for 54% on a year-over-year basis. Gross merchandise volume in fiscal Q3 shot up 73%. Very interesting that they announced a multi-year extension of partnership with Shopify. That's pretty important, of course, as you can understand. Active merchants increased from 12,000 to 207,000, and active consumers were up massively as well. So these are fantastic signs for the company's strong quarter here. Future outlook, what is going on here? Our cost of capital is still lower than 2019, is what the CEO says. Higher rates have not been a real impact on costs, yet, actually, here. And we feel great. We have added $1 billion of new capacity in the last fiscal year. I was also reading that they are not taking on extra debt right now. This is what I was reading on another article, which may be beneficial as well. But okay, let's go back at our tool here and take a little bit of a closer look at what's going on with this company. Now, you will see that their PE ratio, price to free cash flow, are negative, but this can be deceiving because, again, a company that is handling debt can really deceive you on its financials, because its debt is a liability and an asset at the same time, pretty much. Because they are handling debt, it's actually quite difficult to be certain about the financials. There can be lots of legitimate cooking going on. So what I like to examine is, of course, I don't want too many extra shares, which I'm getting here. It looks like the company is diluting investors. That doesn't change. This is a bad thing, of course, for a company. But what I do like to see here is the equity growth, for example. Like, you see that the equity of the company is growing, and then when I compare it to the price of the stock, I'm getting a 2.55 here. And that is one of the keys that I want to examine with these kinds of companies here. Now, 2.55, you will see that it started from 3.4 and it's going down to 2.55. Of course, the lower the better, and typically we want something less or equal to 1. This is more preferable. And of course, returns on equity, for example, matters a lot as well, which is still negative for the company. I would like to get this at a better point at some point. So at a better price, a better ratio. Now, what I do want to actually examine here is I want us to take a look together at this chart. So what am I having here? You will see that this is Affirm Holdings here and JP Morgan Chase. So right now I'm actually showing you the historical chart in candles, hollow candles for Affirm Holdings. So right now it's sitting at 23.14, up quite a lot. Now what I'm going to do is I'm going to overlay the price to book value on top of the actual price of the stock. And you will see here that generally speaking, the price to book of the company has been much higher than what it is today, apart from some time ago, actually, a few days ago, actually, like 3 or 4 days ago, when it was 1.7 over here, and right now it's sitting at 2.7, 2.5. It's about at that range, pretty much. Now, what you will see is that generally speaking, with this company, price tends to be below the price to book value, as you'll see here in the charts, as it's plotted on top of it. So it would be a generally good idea to buy this when the price to book is actually when actually the price is actually lower than even the price to book value, as it's overlaid here. But the other thing that we can do is actually, instead of plotting the price to book value, we can plot the price to tangible book value. And book value of a company, you can take a look at it here, for example. If we go to our balance sheet, you will see that part of the non-current assets of the company is the goodwill, for example, or intangible assets. So what are those? For instance, a goodwill is the extra amount of money that you will be paying for a company to buy a company, just because it is a strong brand and it has a proven name. So this has actually some extra value for the company, some extra book value that you would be paying on an acquisition term, pretty much. And so when we are calculating price to book value actually includes this kind of goodwill, for example, or intangible assets, like it could be a patent, for example, an intangible asset. However, when we're looking at a more concrete way to evaluate a stock, we may want to get the tangible value, which actually excludes all these things like intangibles, like patents or goodwill that I mentioned earlier. And it just actually calculates the raw materials, like the raw assets that the company has, the tangible ones, like factories and things of that sort. And so if we plot that instead of the price to book, I remove price to book and plot this one, you will see that we're still having a pretty similar case here, even though the price to tangible book is a little bit higher, meaning that the company has a lot of value placed on its intangibles and goodwill. Not terribly high, but still a substantial amount. Now, I can actually, first of all, actually add all these, and you will see that the price is actually somewhat in between these two values, the price to book. Almost religiously it goes in between. It almost acts like a Bollinger Band, in case you are aware of trading aspects of stocks. It's in between, basically, the stock price. But what I want to do, and it is very important, is examine this company Affirm here. First of all, I will delete everything here, but I will take a look at the historical chart of a company that is a financial company. It is a bank. It's not exactly the same company, but it's still a financial company. And I'm going to be plotting price to book on top of this one as well. Now, you will see something that is very interesting here. The fact that the price to book of this company is much lower, 1.4 right now. And even if we go price to tangible book here, actually I had that plotted already, the price to tangible book is still 1.7, so it's higher but not that high. And if I actually plot everything here on this chart, every little thing that I can from these two companies, Affirm and JP Morgan, you will see that Affirm's price to book and price to tangible book is much higher than JP Morgan. It's almost like 2 times as much in terms of price to book, and almost 3 times as much as price to tangible book. So we're looking at a more expensive company, and just this fact actually tells me that I wouldn't want to buy Affirm Holdings right now, because it is expensive compared to other financial companies, for example. You can, instance, compare it to Bank of America here. another very interesting one. And take a look at the price to tangible book. And again, price to tangible book and price to book for Bank of America is lower than Affirm, and similar to that of JP Morgan, same story. And so I would be much more inclined to buy a company like Bank of America and JP Morgan instead of Affirm Holdings. Now, Affirm Holdings is not a bank, but still it is a company that is handling debit, credit, and so this can actually really skew your financials, because again, handling credit can be a good thing, but you have to be super careful, and you can really jeopardize the actual financial metrics, and actually make it difficult for a retail investor to understand what's going on. You have to dig much deeper. And so I like to use this method because it gives me a very nice way to know whether I'm buying something cheaply or expensively. And I cannot really easily use something like a discounted cash flow model. It is possible, but it's not the best thing to use for a company of this sort. And so just by taking a look at the price to book, for example, here, the thing that I just did can give me a very nice breakdown on what I'm expecting from this company. It's going down, but I'd like it to be lower in order for me to buy. And so I would potentially consider buying this one if it was closer to 1 or maybe 1.2, something close to Bank of America. When this happened, then I'm pretty sure this company would actually arouse my curiosity, and I would potentially want to buy more. If you take a look at a company like JP Morgan here, for example, if I switch the two to take a look at the JP Morgan, you will see here that JP Morgan's price to book is what we examined, 1.25, and it's going lower. And so again, I would be much more inclined to buy this company, which is also having a positive return on equity, and yeah, looking pretty nicely, and outstanding shares that are going down and everything. So looking pretty good here. Not to mention that it's also profitable. Another interesting thing. You can see it here. So yeah, that's what I wanted to talk about in terms of Affirm. You have to be a little bit careful about these kinds of companies. It could prove to be a good story in the future, but even if you wanted to take a little bit of a leap of faith and buy it now, as it's getting into profitability and it's still a little bit expensive, I would potentially want a better price. Really, I would want a lower price to book. And so I would want a lower price, because the book value is not going to change anytime soon. What may change anytime soon is actually the price over here, which was, I'm pretty sure, better before today's rise, pretty much. So that's what I wanted to talk about in terms of Affirm, and just give you a sense of how I go about analyzing these kinds of companies that handle debt, handle transactions with interest and things of that sort. Now, again, this company is a little bit in between, but since it's not profitable, I wanted to definitely take a look at how they are doing in terms of the price to book, because it makes a ton of sense, again, for these kinds of like credit companies. And you should be doing the same with banks. Insurance companies require different handling than normal. You cannot just be based off of a PE ratio or a price to free cash flow ratio. That doesn't work for the most part in many situations. So thank you for watching this video. I hope you enjoyed. Tell me what you think about Affirm. And if you did enjoy this video, take a look at this other one that I made a little bit earlier. And in that one, I'm talking about GameStop. Tell me what you think about that company as well. You may want to watch this video first. Thank you for watching again. Remember to like and subscribe, and I'll see you in the next one. Bye-bye.